Ever wondered how financial analysts predict trends like future sales or market movements? It's not magic. More often than not, it's regression analysis. In this video, we'll break down how we can use this powerful tool to uncover relationships between variables and even use it to forecast future values. Plus, I'll walk you through a step-by-step example, so by the end of the video, you'll be able to apply regression analysis on your own. Now let's get started.
By the way, if you're only here for the Excel example and you don't want to listen to any theory, then you can skip to the time code shown on the screen right now. Regression analysis is a powerful statistical tool for exploring relationships between variables. One dependent variable, our target, and one or more independent variables, which are called our predictors. The most common forms are simple linear, which is what we have here, multiple linear and nonlinear regression, and linear models are usually the go-to choice for most applications. In financial modeling, the regression analysis helps us assess the relationship between different variables and forecast their future behavior. For example, we can have revenue as our target variable, and then we can have price as a predictor variable, or we can have multiple predictors, like for example, price plus average temperature. If, for example, we are trying to find a relationship to help us forecast the sale of ice cream, for example. We have y being the dependent variable, a is the intercept, which we're going to look at in a minute, and then b is the slope of our regression, x is the independent variable, and then we also have the residual or the error. When we run a regression model, we need to solve a problem. And this problem is fitting a straight line, in the case of linear regression, to a set of observations of the dependent and independent variables. And this is the method that we use to be able to calculate the regression coefficients, the intercept and the slope, to predict the dependent variable. The intercept, or a, in our linear regression represents the expected target value when the independent variable is 0. So, for example, if we have a linear regression model predicting y being our revenue and x is our ad spend, so the intercept a shows us how much revenue we'll get if we don't spend anything on ads. The slope is the change in the dependent variable for each change in the independent variable at the step of 1 unit. So essentially, a slope of 0.7 means 0.7 units of sales per additional ad click, if ad clicks is our independent variable, our predictor. The linear regression model produces a correlation coefficient, which measures how well the model fits our data. Essentially, the regression equation gives no exact prediction of the target value for any predictor variable. The regression coefficients a and b, which we use in our linear regression, represent the best estimate of the actual variables based on the data set that we have. This is why we often introduce a residual, an error, to the model to cover the element of chance that an independent variable can experience variations. One of the measures that we get from regression analysis is the covariance, and it calculates the relationship between two variables. So, for example, x, our independent variable, and y, our dependent variable, our target. We use this formula to calculate the covariance, where xi and yi are the values at each observation. That's why we have the sum here. And x with the line on top are the sample mean, so essentially the average value for x and y, and n is the number of observations in the sample. Keep in mind that if we're calculating the covariance for the entire population, we do not subtract 1 from n. So this will just be n here. We can calculate that on our own, but Excel has a pretty great linear regression tool that does everything for us. Also keep in mind that this formula shows the direction of the relationship. So if this yields a negative number, this means that one variable is going up when the other is going down, then the covariance is negative. and we cannot interpret this further than direction as it is not standardized between the two variables. That's where correlation comes into play. It helps us to standardize the covariance to be able to better understand and use it in forecasting. So it equals the covariance of X and Y, and it divides it over the product of the standard deviations of the variables. That way, we always end up with a result between -1 and +1, with +1 being a perfect positive correlation and -1 being a perfect negative correlation. In terms of building our regression model, it's important to remember that we always work with some inherent assumptions. Some of the most notable are that we expect the variables to exhibit a linear relationship between the slope and the intercept. The independent variable, the predictor, so in our example above, the number of ad clicks or the ad spend, it's not random. And also, if we implement a residual, an error, the values of those residuals follow a standard normal distribution. Regression analysis is widely used in financial modeling because it's really flexible and it allows us to isolate the effect of each independent variable. We also have to minimize the effect of confounding variables. These are such third variables that have a substantial impact on the ones we are analyzing. And regression models take care of that by looking at the effect of a predictor on the target while keeping the other predictors constant. This is for multiple linear regression. And another thing that's essential is to try and figure out all the relevant predictors, all the relevant variables, because if we miss a variable that's really important, this would lead to a biased result. So for example, if we only analyze the weather, we might find a specific relation between temperature and consumption of ice cream. But if we don't also analyze the impact of the price of ice cream, then this will most probably yield a biased result. Something else that we can look at when running a regression model is the p-values. And these help us assess whether the relationships in our observations, our sample data, also exist in the broader population. So the p-value for each predictor evaluates essentially the null hypothesis that the variable shows no correlation with the dependent variable. What this means is that we look at the p-values and want them to be below the error margin, which is usually 0.05 for a 95% confidence interval, which is most common in finance and especially in financial audit. So we look for the p-value to be below that, and this means that the variable is, the independent variable is statistically significant. R-squared shows us how good our model is. It's between 0 and 1, 0 being a terrible model and 1 being a great model. So the closer we get to 1, the better explanatory power our model has. For example, an R-squared of 0.65 means that 65% of the target's variability is explained by the model, which suggests a usable model, but by no means a perfect model. Something else we should be really cautious of is overfitting our model. This occurs when we make the model too complex for the data. So it fits the sample pretty well, but performs really poorly on new data. One way to avoid overfitting is by increasing the sample size or reducing the number of predictors in the model. A general guideline that we use in finance is to start with around 50 observations and add 10-15 more for each additional predictor. So if we have a simple linear regression with only one predictor variable, we can just go with 50 observations. If we have two, we'll go to 60, 65, and so on. Multiple linear regression essentially is necessary because a lot of times in the real world, we don't have just a single predictor. And this model allows us to look at how other factors impact the target variable. So for example, if we are looking at ad spend, we might also want to look at ad spend type. and see if it also has an effect on the variable that we're trying to predict, for example, sales. Something to remember here is that we need to ensure minimal correlation between the predictors, or what's known as non-collinearity. This means that we shouldn't have X1 be highly correlated with X2, because this would skew the entire model. In terms of finance, we use simple linear regression, quite common for time series forecasting, where we have like date, sales, date, sales, date, sales. So it's a really common way to forecast those types. Also, when we do portfolio management or asset valuation, simple linear regression comes up quite a lot. It's also integral to the capital asset pricing model, which links an asset's return to market risk premium. And it also finds it plays in things like beta calculation for stocks, sales forecasting, operational performance predictions, like a lot of use cases. And quite often we can go by just using the slope and intercept functions, and also the forecast function in Excel. Now let's run through an example in Excel. So we have the year, the week, sales, app clicks, and what we want to do is we want to forecast this. So let me just add another column here. We're going to say forecast. And we're essentially trying to forecast sales based on ad click. So we're looking at a simple linear regression model, which is Y, our sales, going to be equal to A, our intercept, plus B, our slope, multiplied by our X, which is going to be ad clicks. That's the equation that we're trying to derive. We can grab our sales and ad clicks, grab the whole thing, and just go ahead and insert a scatter plot. And this would show us what our observations look like. So we can immediately see that there seems to be some connection between our revenue, our sales, and our ad clicks. And if we right click here and add a trend line, we just make it a bit easier to see. So if we add this trend line, this is essentially our linear regression equation, this thing here. However, I don't really like that we're showing sales here. Usually we would show ad clicks here and sales here, so the predictor and the target variable. So what I'll do is I'll go here, say select data, edit, and I'm actually going to switch those two, because right now it thinks that Y, my series Y, which is my target variable, it thinks that this is the ad clicks, and I want to switch that. So my series name will be sales, my series X will actually be my ad clicks. So this is my predictor variable X, and then series Y, my target variable, will be sales. Hit OK, and now we should have ad clicks at the bottom and sales here. Right now, if we select the trend line and go to display equation on chart, we can see the chart equation. We make it a bit larger, put it on here. So this is this thing here. It just shows the intercept at the end, but this is our A and this is our B here. We can also show if I select the trend line, I can also show the R squared, which we can use to analyze whether this makes sense as a model. If you remember, the R squared shows us how good our model is, and the closer it is to 1, the better the model is. So I'll say that 0.84 means that the model is quite explanatory in terms of explaining the variability in the target variable Y. We can also start calculating, for example, our covariance and then our correlation to see if X, our ad clicks, is really impactful in terms of sales. So this, you're going to use covariance S, and array 1 will be our sales here, and array 2 will be our ad clicks. Enter, and we have a positive covariance, meaning that they move in the same direction, but we still can't tell how correlated they are, if it's like highly correlated or not really. So let's go from covariance to correlation, and the function is correl, and again our sales is array 1, and then array 2 is our ad clicks, and you get 0.91, 0.92, meaning that those are highly positively correlated. And granted, this is quite a simple example, so this is pretty much obvious from the way data is distributed around this trend line, but if there was more noise in our scatter plot, those will be quite important. You can now go to the data tab, just close that. And if you don't see the data analysis toolbox, you're gonna go to developer, Excel add-ins. I'm gonna say analysis toolpack, okay. And now if I go to data, I have it up here, data analysis. I can run that, and there's a lot of statistical models here. I'm gonna grab regression, okay, and then my input Y range is going to be sales from here all the way to the bottom with control down, and I'm going to say that I have labels. Then the X range is going to be my ad clicks here, and I can change the confidence level, but I usually work with 95%. It's quite common. And then instead of new worksheet, I'm going to say output range and just put it down here. And we're not going to go into residuals or residual plots. Just want to keep it really simple. I'm going to hit OK, and this is going to calculate some regression statistics and place a summary output here. You see here that we have our R squared, which is same as up here. We have multiple R, which is essentially our correlation here. As we mentioned already, R squared is 0.84, which as a coefficient suggests that we have a decent model that has statistical significance. We can also look at the p-value for our independent variable, the predictor, ad clicks, and if I format this as a number, show as many zeros as we want, but it's like essentially 0, so way below 0.05, meaning that our variable is also statistically significant, ad clicks. So essentially this allows us to have more confidence in our formula here and in our analysis as a whole, yielding a model, an equation that we can actually use to forecast sales. What we can do now is go down here and actually gonna move that here as well because I'll need it for the charts later on. And I can say 2025 and, for example, forecast 10 more items. So I have the week numbers here, 8, 9, 10. And I'm just gonna bring in some expected ad click numbers, and we'll use those to forecast our sales. So what we'll have here is our, following this equation up here, our intercept plus our B, our slope, ad clicks, multiplied by the ad clicks here. Format that as a number until we have 692,555. I'm gonna copy this down, and obviously I have to lock those up there. So this and this have to be fixed with F4, and then I can copy that down. In terms of plotting those on a scatter plot, so if I grab a scatter plot, you see that those would all lie exactly on the trend line because we're using the equation of this trend line to forecast them. So this is not a good visual representation, but what we can do at this point is just grab our sales down to here and insert a line chart, and then do it like that. So this is series 1, our sales, and then what I'll do is go to select data. I'm gonna edit this series and give it a name, sales, and then I'm gonna add a new series where the aim will be forecast, And then my series values will be those here all the way to the bottom. Okay. And now if I hit OK, I can see a representation of let me just extend that. And now I can see a representation of how this forecast fits into the entirety of my time series data here. And based on the volatility that's present here, it seems reasonable. I mean, we can go even deeper, look for, because those are like week numbers, we can look for seasonality and see if this makes sense from this perspective. So for example, here I can grab the label range and select all those, hit OK, okay. And now you see that this is year 1 up till here, and then year 2 is up till here. So it doesn't look like we have a lot of like seasonality. Maybe the only thing is that around the middle of the year we have this spike here and here. But looking at this forecast and looking at the beginning of the past 2 years, I'd say it looks reasonable and definitely usable for a financial model.
That's how easy it is to run regression analysis in Excel to forecast future trends and values. If you found this useful, make sure to check out my full beginner-friendly financial modeling course available for free on this channel. You can check it out in this playlist up here. It will take you from an empty Excel spreadsheet all the way to a fully dynamic, assumptions-driven financial model that you can use for any business. Thanks for watching, and I'll see you in the first video.